I want to take you back to, a moment in time that feels like ancient history,
Right.
even though it was literally just September 2025.
Just a blink of an eye ago, really.
Exactly. So picture this scene. You have Mark Metrick. He's the CEO of the newly formed Saks Global, and he is sitting down with WWD Women's Wear Daily.
And he's basically glowing in this interview.
Oh, he is so confident. He is bragging, frankly.
I mean, he had reasons to brag, at least, on paper.
On paper, sure. He's sitting there telling them, we have data on 30 million luxury consumers. We have 700 million visits to our website. He's effectively planting a flag in the ground.
Right, saying, we understand the luxury consumer better than anyone else on the planet.
Yeah. He's talking about this massive empire.
It really was a classic pride comes before the fall moment.
It was almost Shakespearean, because if you fast forward just over a year, 13 months to be exact, that entire empire has just crumbled into dust.
Completely imploded.
Saks Global, this massive $2.7 billion titan that combined Saks Fifth Avenue, Neiman Marcus, and Bergdorf Goodman, they file for Chapter 11 bankruptcy.
And we need to be really clear with you about the scale of this.
Yeah, please.
This isn't we need to restructure a few leases and close a mall store in Ohio kind of bankruptcy.
Yeah.
This is a catastrophe. We are looking at nearly $5 billion in debt. We're talking about over 100 unpaid vendors.
The vendor list is wild.
They owe Chanel alone $136 million.
That number, it blows my mind every single time I see it. $136 million to a single vendor, it's staggering.
Yeah.
So the question we are answering for you today is, how does a company with that much data, that much prime real estate, and let's not forget the financial backing of Amazon.
Right, the Amazon fact.
How do they implode so quickly?
And to answer that, we're doing a deep dive into a really, really compelling piece of analysis today. It's part 1 of the series, What Happened to Saks Global, published in Forbes.
And our guide for this deep dive is the author of that series, Lilian Raji.
Yes.
Now, for those of you who might not know her, Lilian isn't just an outside observer throwing stones from the sidelines.
Not at all. She is a global luxury communications advisor. She's a fractional CMO, and she's the president of the Lilian Raji agency.
Right.
She has served as a trusted strategic advisor for some of the world's leading luxury brands for over 2 decades.
She knows this world inside and out.
Absolutely. And she writes the Pursuit of Luxury column for Forbes, where she examines how luxury brands use emotional marketing to capture their really passionate customers.
So when Lilian looks at a massive collapse like this one, she isn't just looking at the balance sheet.
No, she's looking at the psychology behind the brand.
And her take is fascinating. She argues that this wasn't just a financial failure, it was a cultural one. She actually wrote that Saks Global lost its soul to a spreadsheet.
That phrase, it really stuck with me. Lost its soul to a spreadsheet. It perfectly implies how they prioritize math over the actual product and the feeling.
Which is a very dangerous game in luxury.
Hugely dangerous.
And today we're going to focus specifically on Amazon's role in this whole mess. Lilian argues that Amazon failed here because they fundamentally misunderstood the difference between buying access to a market and actually being luxury.
It is a distinction that ended up costing them nearly $500 million.
Let's unpack this, because when a company this huge goes down, the blame game starts immediately. Everyone has a theory.
Oh, of course.
The newspapers are blaming the commercial real estate market. The tech guys are blaming the software integration failures.
Sure, and the finance people are blaming the private equity firms for loading the company up with all that debt.
Right.
And look, none of them are wrong. Those were definitely all factors. But Lilian quotes the famous political strategist James Carville to get to the actual root cause here.
The 1992 campaign quote.
Exactly. She says, essentially, it was the customer stupid.
It sounds so obvious, but isn't that usually the very first thing these giant corporations forget?
It is. It happens all the time. Lilian's central thesis in the article is that the 3 main players here, Amazon, Neiman Marcus, and Saks, they were all suffering from what I'd call hallucinations.
Hallucinations.
Yeah, they were seeing a version of reality that simply did not exist.
Okay, let's break these down, because I think this is where the real insight is for you listening. Let's start with Amazon.
Okay.
They are arguably one of the most successful retail companies in human history. What exactly were they hallucinating?
Amazon was hallucinating that efficiency equals luxury. They thought if they took high-end fashion, wrapped it in that prime-style convenience, and applied all that massive data Mark Metric was bragging about.
The 30 million consumers.
Right. They thought they could literally force a luxury marketplace into existence.
Yeah.
They thought they could engineer cool using algorithms.
Which is a very Silicon Valley way of viewing the world. Like, if we optimize the logistics, the desire will naturally follow.
Exactly. But desire doesn't work that way. You can't code desire. Now, look at Neiman Marcus.
What was their delusion?
They were hallucinating that their brand prestige was a magic shield against math.
Wow.
They thought their trophy real estate, those iconic physical buildings, and their affluent client list could somehow support a debt load that was frankly impossible to carry.
They basically thought, we are Neiman Marcus, we are just too special to fail.
Pretty much.
And what about Saks?
Saks had the most dangerous hallucination of all three. They believed they could take the Amazon tech and the Neiman real estate and blend them together into a capital markets machine.
Hang on, define that for me. A capital markets machine. That sounds like complete corporate word salad.
It does. It means they weren't trying to build a retailer at all. They were trying to build a financial vehicle.
Oh, I see.
The goal wasn't necessarily, let's sell the best dresses to the most people. It was, let's create a consolidated entity that looks amazing to lenders and private equity investors.
They were doing financial engineering, not retail engineering.
Precisely. They aren't selling fashion, they're selling a debt structure.
That makes perfect sense. And the common thread across all three of these hallucinations.
None of them asked what the customer actually wanted. They built this quote-unquote comprehensive luxury customer data platform, but they completely forgot that luxury is emotional. It's not transactional.
It's interesting you say that because Amazon has been trying to crack this code for a really long time. This wasn't just a sudden, impulsive move they made in 2024.
No, and that is vital context. Lilian actually traces this back almost 2 decades in her analysis. Amazon's fixation on luxury dates back to around 2008.
That far back?
Oh, yeah. They started hiring heavy hitters early on. They brought in Kathy Beaudoin, who was a big executive at Gap and Piperlime.
Okay.
Later on, they brought in Julie Gilhart, the former fashion director of Barney's.
Oh, wow.
And Amy Glick from Nordstrom. These were people who really knew the industry. They weren't hiring tech bros to figure this out. They were hiring actual fashion insiders.
So they were basically trying to buy credibility with personnel.
Personnel and visibility. In 2012, Amazon reportedly spent 7 figures to sponsor the Met Gala. Jeff Bezos was actually an honorary chair.
I remember that.
That is Amazon explicitly trying to buy a seat at fashion's absolute most exclusive table.
And didn't they open that massive, glossy photo studio in Brooklyn around 2013? I recall seeing photos of that. It looked very slick.
It was very slick. They were trying to create an environment that felt safe for luxury brands. They wanted to show that they could present products beautifully, not just throw them on a white background like a cheap toaster or a pack of AA batteries.
But did any of that work, or was it just a total flop from the start?
Well, this is where we have to be nuanced, and Lilian points this out. It didn't fail everywhere. It actually worked to very specific pockets.
Like where?
It worked for science-based brands.
Science-based, like what? Patagonia? Outdoor gear?
No, more like clinical skincare.
Yeah.
Lilian interviewed Lindsay Namiash, the CEO of Verifi Skincare. And Lindsay explained that they joined Amazon because they fit a very specific profile, clinical, science-backed beauty. For a brand like that, the Amazon environment makes total sense. It's clean, it's efficient, it's heavily data-driven.
That does make sense. If I'm buying a specific face cream because of the peptide count or the chemical formula, I don't need a mood, I don't need lighting, I just need it to arrive at my house.
Exactly. It's utility.
Yeah.
And Amazon is the absolute king of utility. Lindsay said Amazon really handheld Verifi through the whole process.
Right.
But when you move away from utility and try to sell desire, high fashion, the emotional stuff, you hit a wall. You hit what Lilian calls the cooties factor.
The cooties factor. I absolutely love that she uses that term in a serious business analysis.
It sounds funny, but it is a genuine economic reality for Amazon. Lilian quotes Tom Ott, a former Saks executive, and his quote is just devastatingly accurate.
What did he say?
He said, "They don't want you buying your spring dress along with your Scotch tape and your Elmer's glue in the same checkout."
It just destroys the magic.
It destroys the context entirely. Luxury is about exclusivity and atmosphere. Amazon is about getting your Scotch tape in 2 hours. Those two vibes are diametrically opposed. You do not want your 4-figure designer gown sitting in a digital cart next to a bulk pack of toilet paper.
It cheapens it. Lilian notes that for the true Italian and French luxury houses, Amazon just has cooties. They refuse to play ball.
Right. She mentions Peter Smith, who was in fine jewelry, telling her they rejected Amazon because they didn't want to be the pioneer of that model.
Let someone else take the risk.
Exactly. No one wants to be the first legacy luxury brand to say, yeah, put our diamonds right next to the Elmer's glue.
Even when Amazon launched Amazon luxury stores in 2020, which, by the way, was invite only, had these cool 360-degree views, gave brands totally control, it still didn't stick.
Because, as Lillian puts it so perfectly, it felt like setting up a Hermes boutique inside a chaotic marketplace. She uses the analogy of a Marrakech souk.
A souk, like an outdoor bazaar.
Yeah. Imagine a totally chaotic, noisy bazaar where people are haggling over spices and rugs and yelling. Now imagine you build a pristine, glass-walled Hermes boutique right smack in the middle of it.
It doesn't matter how nice the boutique itself is because you still have to walk through the total chaos to get to the door.
Exactly. The surrounding environment matters. You cannot code your way out of the fact that your core platform is designed for volume, not vibes.
So Amazon hits this wall. They simply can't get the big brands to come to them directly. So what do? They decide to try and buy a shortcut.
Enter Saks Global.
Right. This is 2024. Saks is acquiring Neiman Marcus for $2.7 billion, and Amazon steps in as the so-called benefactor.
Right. Amazon puts up roughly $475 million in what's called preferred equity.
Let's pause on that term real quick. Preferred equity. Explain that to the listener who isn't a Wall Street banker.
Okay, think of it like a VIP ticket to the buffet. If the company makes money, the preferred equity holders get paid their dividends before the regular common shareholders do.
Okay, sounds good so far.
But, and this is a massive, but if the company goes bankrupt, they are still standing in line behind the actual jet holders. So it's safer than buying regular stock, but it's nowhere near as safe as giving them a secured loan.
Got it. So they put in nearly $500 million of this preferred equity. But the real meat of the deal wasn't just the equity, was it?
No. The real prize for Amazon was a commercial agreement worth $900 million in fees over 8 years.
$900 million.
Amazon wanted two major things from this. They wanted a Saks storefront directly on Amazon.com. And more importantly, they wanted access to Saks vendor relationships.
They basically wanted the phone book.
They wanted the introduction. They figured, well, if Chanel won't return our calls, maybe they'll talk to us if we own a huge chunk of Saks.
Lilian calls this the queen bee analysis in her article.
Yes, she does. She says the fashion industry basically ignores you unless a queen bee gives you a nod of approval. Amazon tried to buy the nod.
Right.
But Lilian argues, and I think this is brilliant, they should have become the queen bee themselves.
What does she mean by that? How do you become the queen bee?
She introduces this concept she calls the whole food strategy. Think about how Amazon bought Whole Foods. They kept the name on the building, they kept the green aprons, they kept the organic local vibe.
Sure.
But under the hood, it's all Amazon logistics running the show.
So why didn't they just do that with Saks?
Lilian argues they absolutely should have. She says Amazon should have bought Saks outright, completely owned it, and run it powered by Amazon, but kept it very discreet.
Oh, that makes so much sense. Keep the Saks name on the door. Keep the prestige and the heritage. But under the hood, it's just pure Amazon logistics and data.
Exactly. Invisible infrastructure. If they had done that, they could have controlled the entire experience. Instead, they tried to be a partner in a fundamentally broken system.
They invested in a company that was already struggling with massive debt and an identity crisis.
Right. Rather than taking full control and fixing the underlying plumbing themselves.
And now that partnership is, well, it's a total disaster.
It is a very messy divorce. The deal is completely collapsing. In the recent court filings, Amazon's stake is literally described as presumptively worthless.
Ouch. $475 million presumptively worthless. That has to sting even for Amazon.
Oh, and it gets so much nastier. Saks is now trying to use the bankruptcy process to legally cancel that $900 million fee agreement.
They basically want to tear up the contract and walk away from the bill.
Yes, and Amazon is not taking that quietly. They're taking the gloves off. They're legally exploring, quote, drastic remedies. And a lot of this anger centers around real estate.
Specifically, the Saks Fifth Avenue flagship building in New York, right?
Yes.
The famous building, the crown jewel of the brand. What is the conflict there?
So when Saks filed for bankruptcy, they needed cash immediately just to keep the lights on and pay the employees. This is called DIP financing. debtor in possession financing.
DIP financing, that sounds like another Wall Street term we should define for everyone.
Yeah. When a company is bankrupt, no normal bank wants to lend them money because they might never get paid back.
Because they're already broke.
Right. So bankruptcy courts allow for this special thing called DIP financing. It's a special loan that lets the lender jump to the very front of the line. If the company completely liquidates, the DIP lender gets paid first before anyone else.
So it's a lifeline, but with massive strings attached.
Exactly. To secure that lifeline, which was $1.75 billion, Sachs pledged the flagship building as collateral to the new lenders.
But wait, doesn't Amazon have a say in what they do with the building?
Well, they were supposed to. Amazon claims Sachs did this entirely without their consent. By pledging the building to new lenders, it pushes Amazon even further down the list of people who get paid back.
Ah.
If the ship goes down, the new lenders get the building, and Amazon gets absolutely nothing.
No wonder Amazon is furious. They are claiming misconduct. I read they are even arguing that maybe Sachs should just be liquidated rather than reorganized.
Which brings us to a supreme irony that Lilian points out in her piece. She actually quotes bankruptcy lawyer Sid Sheinberg on this.
What's the irony?
Think about it. Amazon is usually the ultimate villain in the retail story, right?
Right. They are the great disruptor. They're the ones always blamed for ruining physical retail and killing the Main Street mom-and-pop store.
But here, in this specific case, they're the most angered party because they tried to play nice and participate in the traditional retail system.
The old system of mortgages and heritage vendors and flagship stores.
Exactly, and they got completely burned by it.
That is wildly ironic. The great disruptor got disrupted by the old guard's sheer incompetence.
And by the incredible messiness of traditional retail finance. Lilian also notes that this stings even more right now because Amazon is facing its own internal issues.
Like what?
They've had major corporate layoffs. They're spending heavily pivoting to AI. Losing nearly $500 million on a failed fashion experiment is not something they can just brush off right now.
Yeah.
It is genuinely embarrassing.
So, looking at the big picture, what does this all mean for you as the consumer or the investor? We have a bankrupt retail giant, a furious tech titan, and over 100 unpaid vendors.
Lilian's final takeaway in the article is really the core lesson of this entire saga. You cannot spreadsheet emotion.
You cannot spreadsheet emotion. That is a great line.
Amazon has essentially infinite money. They have infinite data. But they tried to just buy their way past the traditional gatekeepers.
And the gatekeepers aren't just the Chanel and Hermes brands.
No, not at all. The ultimate gatekeeper is the consumer. And the true luxury consumer values an emotive experience.
Right.
They value the feeling of the purchase, the atmosphere, the prestige, far more than they value two-day prime shipping.
It seems so obvious when you say it like that, but clearly, billions of dollars were bet on the exact opposite idea.
It raises a really provocative question for the future, though. If Amazon, with literally all its resources and data, couldn't crack the code of luxury e-commerce,
Right.
and if the traditional giants like Saks and Neiman Marcus are bankrupt because they carry too much debt, who is actually going to figure out how to sell true luxury online?
That is the big question. Is it possible that the everyday store model, the model built purely on efficiency and scale, is just fundamentally incompatible with exclusivity?
It might be.
Can you ever really sell a Birkin bag on the exact same back-end system that sells AA batteries?
I don't know if you can, but whoever finally figures it out is going to have to care about much more than just data points and conversion rates.
Yeah.
They're going to have to care about the soul of the brand.
Well, this story is far from over. This was literally just part one of Lilian's series. There is so much more to uncover about the internal workings of Neiman Marcus and Saks before this merger even happened.
Oh, absolutely. If you want to understand the full scope of this collapse, you really need to read the full article in part 2.
You can find Lilian's work directly on Forbes. And if you want more of her analysis on the luxury industry, which, as we've seen today, is incredibly complex and pretty brutal, you should definitely visit her website at www.lilianraji.com.
And you can also connect with her on LinkedIn, Instagram, and YouTube. She shares a ton of great insights on those platforms as well.
Definitely check those out. It is a fascinating case study in what happens when you completely ignore the human element of business. Thanks for listening to this deep dive. We'll catch you on the next one.
Goodbye, everyone.